Hello, everyone. Good day, everyone. Good morning, good evening, good night, wherever you are in this part of the day around the world. So we start our last and final episode of the 17th Maintenance Cost Conference, the MCC. It's again a virtual series this year, and we'll be talking about operating in the post-pandemic. So we have a number of esteemed speakers lined up today for you. The recording will be available at the end of the session, as you all know from previous sessions on the MCC website. Some logistics things, your microphone is automatically muted. However, there is a chat function with the tool. Please, during the session, during the presentations, please type up your questions in the chat box, and we'll address them at the end of each speaker. We will have the questions that are related to that specific presentation. So apologies, I have some troubles with my camera. Probably it's some network speed from my end, so it will be coming on and off. In the next slide, you will see our competition law guidelines. It's a virtual conference, so I don't think you have the opportunity to have much interaction and exchange views live, at least. However, please note that pricing information, market sharing, boycotting, relationships with stakeholders, with industry, are not allowed to be discussed in these meetings. So just in general, be cautious on how, and actually you should not be exchanging that type of information unless you have legal advice on how you can do it properly. And moving on to the next slide, you will see the agenda for today. The presentations that we'll be talking will be, first of all, related to leasing and maintenance costs, about what would be the post-pandemic new normal, as we will call it. Then we will have a view about the MRO Outlook. What are the COVID implications for airlines and MRO suppliers? And finally, we'll hear from an airline navigating through the pandemic and the experiences that they had during this time and with return to service. So in the next slide, you will see our esteemed speakers for the day, the presenters. We have Phil Seymour, who is the president and head of advisory for IBA, and he's one of the experts in leasing, aircraft leasing consultancies. Jonas Murby, he's a principal with AeroDynamic Advisory, a consultancy related to supply chain and the MRO. And finally, we have Swaran Sidhu, who is always with us at the MCC. He's the head of fleet technical management at easyJet, and he will share with us their airline experiences. So we quickly moving on to the next, to our first presenter for the day, Phil Seymour. He will be talking to us on maintenance costs, aircraft leasing in the post-pandemic new normal. So with this, I'm going to hand it over to you, Phil. Again, many thanks for being with us today. The floor is all yours. Thank you.
Thank you, Chris, and the IATA team. Pleasure to be presenting to you today. Clearly, you know, we're in a very difficult period, and that who'd have thought that it would still have continued for so long. Just to give you a little bit of background of myself, I've just celebrated my 45th anniversary in aviation, having started as a 16-year-old technician apprentice at British Airways. I worked for several airlines, and in '91, I think I had that traumatic experience of the failure of Air Europe in the wake of the first Gulf War. So I've been on that side of the table where an airline fails and you go from 100 100% full on to really not understanding what's going to happen in your own personal world, let alone the aviation world. So I have a lot of empathy with everyone at the airlines right now. In that time, I did work for 6 airlines, working a lot on maintenance costs, and then as leasing became more dominant, got more involved in that sort of leasing side. So the next slide will give us a view of what we're going to be talking about today. This is all about the influence of aircraft leasing on maintenance costs. We're going to be looking at some of the lease end date projections, how costs and reserves are being impacted because clearly utilization has changed. We're starting to see increasing issues between lessors and airlines because of the, let's say, early termination or failure of airlines, and but also there are some opportunities. There are a number of startup airlines taking opportunities, so it's not all gloom and doom. So we'll be touching on what issues are likely to be coming ahead in the next few months. In terms of are we going to see changes to operating lease contracts in the future? This wasn't necessarily just pandemic. This was also related to what was then, the unprecedented grounding of an aircraft for so long, related to the MAX issues. So let's get stuck into the presentation. I'm going to look firstly at where we're looking at the lease end forecast. Now, this has been rather complicated because, of course, a lot of leases that were due to end last year, lessors had very few options in terms of where to place them. Airlines were perhaps looking at not having to spend cash on some of those redelivery conditions. So there was a lot of moving of lease end dates to the right. In terms of where we see the next few years, there's an increasing sort of bow wave coming in terms of lease ends. So the graph I'm showing you there, I think it's reasonably well formatted for you. You can see an increase in lease end forecasts over the next few years. Particularly narrow bodies will of course always be the majority, but we're going to start to see increase in wide body redeliveries as well. And as most of you know, the costs associated with those are perhaps more significant. They're a more difficult product for the leasing companies to move, and in terms of configurations, there's a lot of potential issues that come up. So in terms of what's moving these lease ends, and we call them the cons, what are the increasing pressures on the industry that we're likely to see? Well, we are expecting to see continued handbacks. We still expect there to be airline issues through the 3rd and 4th quarters of 2021. A lot of airlines have managed to survive due to government grants, the furlough schemes in various countries. As they come to an end and operations start, that's really when there's going to be an increased cash draw. So we don't think that the issues are over yet. And of course, as the world starts moving again, we start to see increasing oil price. And there is a bit more of a greener focus now in terms of operations, and I'm going to be touching on that. I've got a couple of slides that I'm going to cover that shortly. In terms of the positives, perhaps reduced lease ends, we are seeing extensions on some types of aircraft. There's actually been an increase in sale leaseback activity as airlines look to raise cash. Some lessors, so long as the airline is seen as a reasonable credit, will be offering cash for those aircraft, but of course you're going to be exchanging those for an operating lease term. So there will be, some increases in leases, and those are impacting the lease ends. If some of those go on to 5 or 6 year leases, obviously those will be coming back beyond the scale of this graph, 2027, 2028. And refleeting process is slow. We've seen deferrals of many wide bodies. The 777X program has been delayed. We thought by now maybe Boeing would have come out with a mid-market aircraft, but that has been a bit slow off the blocks, clearly, as Boeing has had to deal with the MAX issues. So we do think there's going to be some shake-up, and we're not quite sure yet where the OEM production line numbers will bottom out. Clearly, they wanted to keep the production lines going, but there were some significant drop-offs there. So let's move on to some of the maintenance considerations here. I do think we're in a very challenging period in terms of the practical issues. We've seen long storage periods. We've seen aircraft coming back into service which have actually had some issues, and I think there's a lot of concern about the maintenance processes. They should be fairly standard, but we've had aircraft parked up in, let's say, unusual places, maybe not main hubs, but some coastal airports in order to get lower and cheaper parking rates. So we have seen a difference in storage locations, and of course the maintenance manual provides you with the obvious practical things to do, but we are seeing differences, whether it's dusty conditions, sandy conditions, coastal conditions. So it does really need a practical maintenance and engineering team to get those aircraft back flying. And of course, with the drop-off in utilization, there's been a lot of liaison with regulators in terms of whether scheduled checks, how far they can be deferred, and whether there's any opportunity to perhaps slim down some of the maintenance checks, not to make anything unsafe, of course, but in terms of perhaps making work packages more practical, less cash demanding, and actually maybe moving some things into maintenance checks over the next year or two rather than doing everything right now. But there has been some difference. We've seen other airlines taking the opportunity of really trying to hit that maintenance plan and take the opportunity of getting work done now, but big differences depending on the cash situation of the airlines. Engines, obviously there's been a lot of talk about green time usage, deferring shop visits, trying to make use of engines that have been on wing on one aircraft rather than send an engine away from an operating aircraft and require cash. You know, that spare engine has been used as much as possible. So I think we're starting to see on the graph I produced on the right hand side here, the blue bars were our pre-COVID projections of shop visits, and as you can see, there was an increasing number through to the end of the decade anyway. But what we're seeing now, the green line is the actual number of shop visits through 2020, and it was drastically reduced. And you don't get something for nothing. If you're going to push those shop visits to the right, they're going to come back. There will be some shop visits that may now never happen, perhaps those third and fourth shop visits. Perhaps aircraft are being converted, some of the older 737 NGs converted into freighters. Perhaps their utilization will mean then that they won't need as many shop visits. So I think on balance, there will be some of the larger shop visits, there may be some drop off. But as I say, overall, I think we're looking, and it's some years away now, but once we get to 2026, we may well see a vast increase in the number of engine shop visits. So I think that's one to keep an eye on. We've obviously seen, I suppose I need to define a shop visit. The shop visit here were really what we would call the performance restorations, where most of the modules have gone into, and perhaps there's LLP changes as well. But what we are seeing is numbers of shop visits may be fairly stable, but they are more related to repairs, emergency shop visits, and much lower work scopes than we would have normally expected. And that in itself has led to some discussions between lessors and lessees, and I'll come back onto that shortly. We are also seeing some issues in terms of the MRO industry capabilities and resources. It's really been a tough time for everybody, and we've seen some people who were perhaps working as expats at MROs in overseas facilities deciding enough is enough. Maybe they want to go back to their homelands. They're focusing more on the short-term issues associated with their families. We've seen the issue, obviously, over here in the UK, we've had the Brexit issue, which has impacted a lot of the labour that was working here. But generally speaking, we've seen a number of MROs go through redundancy processes, looking at early retirements, and we do see several MROs suffering a little bit in terms of the resource capability. I'm talking about experienced people here. And there have been some logistical blockages as well, waiting for spare parts, getting things in time have been becoming more of an issue for the industry. The utilization and role change, aircraft utilization has been changing. It's not just a regulatory issue. Clearly, the maintenance planning document is based on the expected utilization and a typical hour to cycle ratio. And that's fine when you've got an aircraft entering a fleet. You obviously plan for it to arrive, you know what sort of routes it's going to be flying. But this pandemic has caused a lot of fleet reviews, perhaps reduced utilization. Obviously, storage is a zero, but clearly changes with fleet plans that perhaps aircraft that airlines thought were going to be flying 2,500 hours a year, perhaps they're only flying 1,500 hours a year. How long will that continue? The regulators will want to understand if there are changes required to maintenance programs. But of course, it's not just the regulators. You then need to check the operating lease, because there may be minimum utilization period expectations in there, and the lessor will need to be advised if there are changes. Don't wait to the end of the lease before having this conversation. Speak to the lessor right now if you think that clauses that are in the leases are going to need to be changed, or at least addressed, and out of courtesy let the lessor know. But of course there may be significant changes in terms of maintenance reserves that come along with that, and I'm going to come back on to that shortly. So let's have a look at the next slide, please. The graph on the right I've just put there as a reminder in terms of lease ends and what that means. In the past at IBA, we produced a lot of data in terms of the costs associated with aircraft leasing. We obviously know that operating leasing is a very popular acquisition process, but of course there are additional costs associated with that. We've estimated that typically a narrow body aircraft, it can cost probably another couple of $1 million than you anticipated over and above the normal maintenance plan. This is because the redelivery conditions are not really associated with how you as an airline have operated the aircraft. It's all about putting the aircraft back into a commercial condition, and it may have nothing to do with airworthiness or regulation. It's all to do with the commercial aspects of redelivery and how the lessor perceives value to have been impacted. So there can be some big differences, as we've seen several issues over things around interior configuration, conditions of the interior, things like shop visits and how they've been handled in the past. Now, I've called this sort of the typical cyclical tug of war. It comes and goes according to the market. In times when the market is very strong and the lessor perhaps knows in advance of a redelivery exactly where that aircraft is going to go after it's been redelivered, it's a very happy situation. Everybody's fine. The airline's happy to redeliver. There may be some discussion with the lessor about exactly maybe there's some compensation instead of exact performance to the redelivery condition, and a lot will depend on the demand for that aircraft from the next lessee. In the good times, the next lessee is probably going to be quite happy to take the aircraft, and there's no issues. In a time like this, we really do see probably the worst of both worlds. Airlines are trying to preserve cash. They may not want to put engines through shop visits that may be required under the redelivery condition. Meanwhile, the lessor is concerned because it may not have an immediate home for that aircraft. So there's no advantage for the lessor in conceding on some of these points. So we are expecting to see a number of increased litigation cases as this process continues. And of course, there will be some issues where airlines fail, but there may be recourse to perhaps a holding company of that airline. So we're seeing increased issues coming around in terms of how lessees have been handling some of these redelivery conditions. And of course, deliveries have been pushed back, some cancelled. So we expect to see some issues coming up between airlines and lessors. I think as well, we need to remember, even in a pre-COVID world, the operating lessors, they didn't have hundreds of technical guys liaising with the MROs and the lessees over these conditions. They tend to have a very limited supply of project managers, and they outsource a lot of work. And our IBA benefits from some of that work, but actually we tended to find ourselves working more for airlines these days in terms of handling that relationship with the lessor. So that's again something we do talk a lot about in our own webinars in terms of the issues and practicalities of that process. But you now have a situation where lessors who were already fairly thinly resourced have now got a huge demand profile. There are multiple workouts. I was at a conference, the ISTAT conference last few days, and one lessor was saying they're absolutely exhausted. Just one of their project managers has been handling 100 different restructuring and workout scenarios over the last 18 months. There's also additional aircraft that have come on the market because as airlines have failed, aircraft which have been financed, not on operating lease, banks have had to repossess aircraft as well. So it's not just this lease end forecast that I'm showing you, it's now an increased number of aircraft that are on the market anyway. So there's a lot more competition for technical resource. Actually, that's probably been one positive because we do, at IBA, we've actually hired several airline staff, people who've been working for airlines who've perhaps either been furloughed or realized that there's no particular great future in their particular airline. So companies like us have actually benefited from some of the awesome airline technical resource that there is, but actually there's more competition for that resource as well. And of course, that's been exacerbated because with the mobility issues we've had over the last 18 months, we just haven't been able to fly an expert from Europe to Australia, for example, or to South America. So we've had to find more local resource, and perhaps they're not as experienced as the teams who've been through this several times. So I think there's been a lot of issues. We know that airlines who are due to return aircraft have been suffering because the lessors have just not been engaging on redeliveries that are due to occur over the next 12 months. The lessors have just been focusing on today's problems. So this has all been stored up into what we see as several redelivery issues, and this won't be sorted out in the next few months. This is going to run for the next year. Let's have a look at the next slide, please. I'm covering a few things on this slide. In terms of the lease contract considerations, this is where I'm touching on some of the issues that were sort of pre-COVID. Obviously, with the grounding of the MAX, it got us into unprecedented territory where an airline may have signed a 5-year, 6-year, 10-year operating lease in March of 2019 and then found that the aircraft was grounded. What do? There are obviously warranty provisions that you're entitled to take up as part of your lease transfer of obligations to you as an operator, but those warranties would have been negotiated with the operating lessor. They're usually fairly standard, but it's important that you know the detail of those. But of course, having an aircraft grounded for so long, what are you going to do? Are you going to continue to pay the rent? There's at the bottom of this slide, I put a definition of hell or high water and what that actually means. Most operating leases have this type of clause in them, and basically it's a promise to pay contract, and it's a non-cancelable contract whereby the purchaser or lessee must make specified payments regardless of any difficulties they may encounter. Clearly, if an aircraft isn't fit for purpose, the obvious entity that you're going to be claiming against would be the OEM, but you're still obliged to be paying the lessor that rental. Of course, you would be claiming that perhaps back from Boeing, but there may be some other limitations that mean it's going to be a tough fight all of the way. There's obviously an impact on delayed maintenance and the reserve funds that were expected. This is similar to the COVID situation, where there may have been minimum monthly payments or a payment towards, let's say, an A320 6-year check and 12-year check, where the clock has been expected to be running anyway. We know that the OEMs have provided some guidance on the ability to, let's say, stop the clock, but the regulator needs to be involved in that process, because corrosion is corrosion. It doesn't actually stop in a pandemic. So I think there's a lot of things that are being stored up right now that we're going to be seeing over the next year or two, which will cause some discussions over perhaps increased maintenance cost as and when these issues are found. I think in terms of the questions we're being asked now, where airlines are sitting down negotiating operating leases, should there be provisions in the future for this type of situation, where there's a pandemic or where there's a long-term grounding of an aircraft, perhaps because of an AD issue? We're seeing those requests being made. They appear to be being handled on a case-by-case basis. Usually we're seeing a lot of pushback, of course. The last thing a lessor wants to do is really attempt to anticipate issues over which it has no control. And we're not quite sure yet whether we'll really see clauses in the future, sort of pandemic clauses, or where hell or high water will be alleviated in some way, either due to pandemic or grounding of more than, let's say, 6 months or 12 months due to technical issues. But we are seeing a more popular use of step down and step up lease rates. This is obviously as a result of the pandemic. We're seeing a move towards things like power by the hour, that type of situation. But actually, this is a longer term view in terms of seasonality and maybe a floor lease rate versus an upper lease rate. And in some cases, we're seeing discussions over profit share, in terms of you get rate X as your standard lease rate, but if the airline becomes more profitable, or perhaps even if that aircraft starts being utilized more often, then there's some increase or step up in that situation. So let's have a look at the, sorry, that slide. I was about to change slides. Sorry if I didn't quite cover the other point. I think this is just a reminder. The graph on the right is just really revisiting some of the points in terms of storage. We obviously saw that massive peak, and now we're starting to see some hope that there's more aircraft coming back into service, but it's a long, slow journey. So we're still expecting lots of discussions between lessors and lessees over this situation. Moving on quickly, I think I'm aware I'm maybe a little bit slower than anticipated. We've been asked a lot of questions recently about the MRO situation and where it sits in the ESG space. I think airlines, I think you're very lucky to have IATA as your association, because you have the guidance with the Airline Sustainability Reporting Handbook, which has really taken the high-level global reporting initiatives and put them into airline speak. And a lot of airlines now, we're seeing, using that to really shape their own sustainability reports. But for the MROs, unless you're part of an airline and you're considered part of that same sustainability report, the independent MROs are in a bit of a tougher space in terms of the guidance that they have, because we don't really see much other than making their own interpretations of the global reporting initiatives and what they need to cover. And also, it appears as if there's a bit of a lack of understanding in terms of the scope 1 and 2 aspects. This probably needs a whole webinar in itself, but just to give you a intro to that, if you're not already aware, scope 1 are the direct emissions that you're creating in the organization. Scope 2 will be the more sort of indirect emissions associated with your business, and then scope 3 is your supply chain. So some of these may already be somebody else's scope 1. Just to put that into context, an airline scope 1 emissions will be emissions from flying the aircraft from A to B. leasing company. A leasing company doesn't actually fly the aircraft, it owns the aircraft, but it will need to make note of the emissions its aircraft is producing under its Scope 3 obligations. Now, for MROs, it's quite a difficult process because the logistical exercise of firstly getting the aircraft into the facility, then the process of dismantling, perhaps sending parts out to workshops. They may be internal back shops as part of the MRO, or they could be the other part of the world. As we know, a lot of these specialist repairs need parts to be shipped from one continent to another. In fact, one side of the world to another, where there's special, perhaps plasma processes required for engine shop visits. So I think there's a lot of work to be done in this MRO space. Obviously, IATA will have some input where airlines are associated with that, but I think the MRO considerations are still a little bit behind and are going to be quite challenging for the MRO, particularly the third-party MROs. I've mentioned here in terms of looking at some of those workshop processes, but also I think we were brought up in a time where the idea was to have just-in-time maintenance and assembly, but if that means more frequent flights are required to get part A from part B, instead of sending 100 part A's to a facility so that they're in place, can be stored, and that reduces the amount of emissions in terms of getting parts. It's that level of detail that's required. Then of course there's the waste issues. I haven't really touched on the broader S and the G. That I'm just really looking here at the E aspects of the environment, but clearly a lot of companies are going to have to look at their social and governance aspects, makeup of the board in terms of the diversity issues. Governance, I mean, I think as an airline industry, there's a lot of oversight, there's a lot of governance, but there are still some areas that need to be looked at in terms of acquisitions. We saw some rather difficult situations where OEMs were being investigated for allegations over bribery and corruption in terms of placing aircraft. So there are still some governance and oversight issues which the airlines need to be facing up to, and that follows on into the MRO sector as well. Our industry generates a lot of cash. It generates significant transfers of US dollars, other currencies, and we have to have very strict governance policies there. In terms of the next slide, really, I just wanted to this is a bit of a overt or less transparent point. We have joined up with KPMG to be producing the carbon emissions index, and this is where we've tied in our fuel burn data with the utilization platforms such as Flight Radar 24 and Spire, so that even on a particular MSN aircraft we can track, and based on the miles flown, we calculate the CO2 emissions per seat mile. We do the freight version of that as well in terms of per freight per ton mile as well. But this is just an indication. The reason this looks of interest to me is if you go back to March, April, May of last year, the CO2 per seat mile did have a peak. That's actually associated with a big drop off in some of the efficient narrow bodies and wide body flights. There was a lot more freight flights which utilized some of the older generation 76s and 747s, so they were less efficient on a cost per seat mile basis, but that's just a bit of a blip. But generally, the industry is doing a good job, and I think we and IATA probably need to make more positive sounds about what aviation is doing. I think in that respect, I'd probably better move on. If you do have questions, please fire them towards me. I don't know if there's anything specific come up, Chris, during the presentation I've given, or whether those questions will come later.
Thank you, Phil. Thanks for your presentation. So yes, indeed, we please first of all encourage the participants to use the chat box and provide and ask any questions you may have. One question that came in is it's about leasing other parts of the aircraft. We know that there are some engine lessors, and that's above and beyond the aircraft lessors. There are some engine lessors, but do you see also that market developing in other components, like more even engine lessors or APU leasing companies or other large components that can be leased around? Do you see the opportunity there, or have you been asked this question by anyone else?
Yeah, look, I think where we're at in the economic cycle, Chris, is that there's a desperate requirement for cash. And I think airlines and MROs are looking at what equipment they have on their balance sheets. And if they have valuable equipment that is sitting there and there's an opportunity to raise cash, then I think the operating lease opportunity is there. But it really is to use that phrase, it's sort of horses for courses. I think the large aircraft lessors, their whole cost model is based on doing the large big ticket solutions, so they'll do a sale lease back on a wide body or a narrow body. I then think there's obviously the engine lessors who will look specifically at engines. I think some of those other parts, the high value rotables that you mentioned there, the APUs and landing gears, and indeed some other high value parts, that probably falls more into some of those suppliers and stockists of parts. I think they probably are knocking on the doors. It will be interesting to see with some of the MRO conferences over the next few months. I imagine the airlines will be having a lot of interest from some of those companies, but of course it is a credit risk. It's all about giving an airline cash. Is that airline going to be operating profitably in order to pay back those 10-year leases on APUs and landing gears? But I'd have thought there probably is a big market opportunity there for somebody to get hold of those. The other area we've been looking at are things like simulators. Airlines own simulators. Do they actually need to own those? Could they be put on operating leases? So the simple answer to your question, Chris, is yes. I think we will see an increase in that type of activity.
Thank you, Phil. One other question is about cargo conversions. A lot of aircraft being converted to freighters these days, to cargo, passenger aircraft to cargo conversions. Do you see that with the industry returning to normal and the availability of belly space, is there going to create a huge issue in the market from that aspect? What's your thoughts about it?
I think clearly there's a difference between the wide body P2F sector versus the narrow body. I think we're seeing a lot of the 777 program. I think there was a new one that was announced last week, the Mammoth program for the 777-300ER. There's that sector's getting a lot of attention, as you say, because of the drop off in long haul passenger flights. There's a need for those wide body conversions. So I think the question is, well, will that really be there in 3 or 4 years' time? If the market goes back to 2019 levels by 2025, is there going to be a change in that? And I think that is one of the risks, because clearly converting the likes of an A330 or 777, it's a heavy investment. I think $15–20 million at least. So is there going to be a payback there? I think there will be, because there's still a lot of replacements. There's still a lot more inefficient wide bodies out there. So I think they will be taking up some of that opportunity. I think the narrow body sector is slightly different, because I think the express and package freight business is kind of here to stay now. We're all buying stuff off the internet and we want it delivered tomorrow, okay, and we're willing to pay for that. So I think that narrow body package freighters, so 737 NG programs, the A320, 321. I think we're going to see those continue even when the market returns to normal. And again, there's still a lot of older freighters to replace, and you can't buy a new narrow body freighter, of course. You know, Boeing will sell you a new 777 freighter, but you can't buy a new 737 MAX freighter. So the narrow body P2F is a totally different market, and I think it's probably here to stay.
I think this is, thank you, Phil, again. I think this was the last question. I appreciate your time today with us, and thanks again for your participation. And we hope to see you next time on a face-to-face meeting rather than a webinar type of thing. Thank you, Phil.
So we've enjoyed being a strategic partner of IATA, and we expect that to continue. So thanks, Chris.
Thank you, Phil. Always appreciate it. Okay, with this, we will move on to our next speaker for the day. We will have Jonas Murby, an old friend for many years. He's a principal with the AeroDynamic Advisory, and he will be talking to us about the Outlook, the MRO Outlook, the MRO Outlook implications for the OEMs and the commercial aerospace supply chain. So the floor is all yours. Thanks, Jonas.
Thank you very much, Chris, and thank you, Phil, for a great start for this seminar, and thank you to the participants for listening into this. You may have seen my colleague Kevin Michaels talk about the supply chain a few weeks ago. Some of that story overlaps with the story that I'm going to tell about the MRO Outlook. So you may see some overlapping material, especially on the foundational side here, but my focus will be on the MRO. So let's get going, and we can head into the first slide. Thank you. So let's start with our air travel recovery scenario, and why, for those of you that have seen our material during the past year or a few years, why do we always head back to this air travel recovery scenario, the paying passenger? Well, it's because everything flows from this, not only the level of travel, but also the dynamics that this creates. Everything flows from here. And we've spent a lot of time trying to predict how things return. We agree with our clients that, or with most observers, that there seems to be a big pent-up demand for travel. Ultimately, travel will return in a slightly different shape, but it will return. However, there are a number of factors that are keeping travel down, and we believe it'll keep travel down for still quite a while. We don't expect things to recover to 2019 levels until the end of 2023 or in 2024, and I will soon tell you more about why. So let's head into the first reason for this. I think you may have seen this slide a few weeks ago as well, if you saw that presentation, but this is, if we look at the global population of adults, 6.2 billion adults, and their vaccination status. So basically here it says it's by region, the number of inhabitants, and how many have had 2 doses, 1 dose, or no dose of corona vaccine as of August. And what it says is that 52% of the global population hadn't had any dose of any vaccine at all. And only 20% of the population had 2 shots. It also shows that there's a significant regional disparity here. North America and Europe have gone quite a long way, as well as certain individual countries in other regions. China is fully vaccinated through the Sinopharm vaccine, but as you see, there's a huge regional disparity here. And I think that contributes to a very big mix in sentiments that we see globally, which we never really saw to that extent pre-COVID. And I think the next chart is a good illustration of this. So if you change to the next page. This is what global travel looked like pre-COVID. So 2019 global RPK broken down by regions, so intra-region traffic and inter-region traffic. And what we have heard from America, where a lot of the traffic is coming back, is you hear these anecdotes of airports being full, and it really contributes to a sense, if you're there, you get a sense of that everything is coming back, there is pent-up demand, everything will be back soon. Similarly, if you have been flying inside China, you may have seen the same thing. And now as Europe is kind of slightly opening up to leisure traffic, myself, who's soon going to fly to Amsterdam for the first time in 18 months, I'm kind of feeling the same thing. But it's important to really see the global picture here and to show that most of these markets will not reach 2019 levels until 2023 or 2024. So it's a long way back. And I want to, let's head into the next slide to really show what 3 factors we think are holding the recovery back. So we talked about the vaccines a little bit already. And as we say, a huge part of the global population still hasn't had their first dose. Actually, the capacity for vaccine production is really gearing up, and the theoretical capacity for next year is 15 billion doses. So that's nearly like two doses per person if you do that across the adult population. However, it's the theoretical capacity. We don't really know how it turns out in reality, and only a third of those are of this mRNA type, the Pfizer or Moderna, which have had the best effect on the new variants, which I'll talk about soon here. Plus, you have challenges of distribution and vaccine skepticism and so on. So in theory, we could get through this in about a year, but there are many challenges on the vaccine side. Secondly, with the vaccines, we're not chasing a static enemy here. The target is moving, and that's called variants. Actually, out of the total population globally, only 3% have had confirmed cases of corona. We know there are much more than that. Let's say it's 10% of the global population. Still, that means 90% of the global population has not had the coronavirus. And that means that there's a huge opportunity for that virus to spread and to mutate along the way. We know the Delta variant is much more infectious than the original version, and there were issues caused in China. Fully vaccinated China had multiple outbreaks in August. Now they recovered from those outbreaks, but it still shows how volatile this situation is. And then finally, the government's ability from, 170 countries or 200 countries, the ability of governments to come out with a coordinated set of policies to take on travel, it's just an enormous challenge. And this has been something that IATA has pointed out for a long time. We actually tried to summarize 4 different countries' policies along this spectrum. You know, on one side of the spectrum, you have Australia with no COVID policy. On the other side of the spectrum, you have a country like Mexico, which has been very open to travel throughout. And if you try to, in a short and concise table, try to summarize what this means for travel considerations, PCR tests, quarantines, and this and that, we couldn't even summarize 4 countries in one simple table. It's really, really difficult. And what does that mean? Well, it means business travel becomes very unpredictable, and international travel in general. So unless we're past Corona, or unless we have this global scheme that makes it more predictable, international travel will be far from recovered for a long time to come. Next page. So if we divide the passenger flows here into intra-region, so the domestic and intra-region flows, that's the blue line here. We think that returns relatively quickly. That's in line with what others think here as well. It'll be a bumpy road, but it's kind of returning to previous levels relatively quickly. on the other hand, inter-region traffic, the typical long-haul flows between Asia and North America, between Europe and Asia, and so on, for most of these, it comes back. It comes back later. But not only that, there's a huge downside risk to this, as we believe. And if you look at this from an airline fleet planning perspective, you definitely make different considerations when it comes to the closer traffic, the intra-region traffic, compared to this long haul, and what bets do you really make with your capital on the long haul traffic. And how does this impact, if we look at the MRO side, how does this impact how airlines plan for MRO? How many long haul aircraft will they be operating next summer? When, how do they plan the maintenance for these aircraft? Much more difficult to handle. Next page. However, there is one part of the industry that has come back really nicely over the past year, and it's air cargo, as Phil mentioned as well. The air cargo growth story here, it's not only about the lack of belly cargo capacity, it's actually also about a modal shift of cargo from sea freight to air freight. And this is a structural trend as we see it. It's driven partly by the e-commerce, which you see the example here. You see the traditional retail supply chain where the focus has been on low transport costs, building up inventories in the stores. And so you order huge amounts at the same time, you bring those over with ship, but that provides a longer transport time of, say 125 days from a factory until it reaches the retail store. That is being replaced more by the e-commerce retail supply chain, where something is sent directly from a factory to a fulfillment center, for example, by Amazon, and then out to the customer. Here, the transport cost is much higher, but on the other hand, the cost of inventory is lower. And this is the trend towards e-commerce is general, but we also see other trends of fragmentation of the supply chain, because we know parts of the supply chain are moving from towards other countries in Asia. We see trends of nearshoring the supply chain closer to home to some extent, and we see a general volatility in just the general global market due to COVID, but also due to geopolitics, which means that the planning horizons have shortened, which means the orders that you place are smaller, and that means that it makes better sense to send it by air rather than by sea. So we see a lot of structural tailwinds for air cargo, and I'll come back later to you and tell you what that means for passenger to freighter conversions. Next page. So what does this mean for airline MRO? Well, we are tracking airlines across the globe here and how much they spend on MRO, and the difference in sentiment is really clear here as well. On the Chinese side, MRO activity has remained surprisingly intact, of course, primarily due to that, or only due to the domestic market. In the Americas, we saw MRO expenditures actually recovering all the way since the low point in the second quarter 2020. MRO activity has been on a recovery path. Now, there are differences between airlines. The regionals have come back earlier. Some of these low-cost carriers, they are back earlier. Some of the network carriers are at levels slightly below what you see here. On the European side, it's a completely different story, and also in Asia Pacific. Here, you haven't really seen any increase in activity since the third quarter last year. So it's basically remained flat over the past half year. And the only increase you've seen in spending has been from carriers such as Wizz Air, which is a low-cost carrier, aggressively expanding, or Aeroflot, which has a huge market domestically in Russia. But apart from that, most airlines are way beyond their 2019 spending when it comes to maintenance. And the same in Asia Pacific, a few domestic airlines leading the way when it comes to increase in MRO activities, but most airlines have really low levels. Next page. And this, if you look at this from a kind of an investor point of view and try to see what does this mean for MRO activity for the full year 2021? Well, we basically, the fourth quarter activities roughly are going to remain pretty flat compared to what they did in 2019. And overall, given that 2020 had one really good quarter and that the recovery has been pretty slow in 2021, we think overall for 2021, MRO activity is only going to be up by some 5%. On the next page then, I want to just take a look at the new airline MRO situation post-COVID. So let me just take you through the flow here on air travel, what that means for the airline businesses, and what that means size air and what that means for airline MRO. So to summarize air travel post-COVID to the top left there, we see for a number of years still market uncertainty. It's not linear where things will be heading. It's going to be a lot up and down. We see a reduction in business travel. We know that externally facing business travel will to a large extent come back, whereas internal business travel, intra-company travel will change. And depending on what company you ask, you hear everything from business travel being cut by 20% to even 80%. There will be a reduction in business travel. So what does that mean for airlines? Well, in the past, 50% of airline revenues came from the business side and 50% came from the leisure side. It meant that the airline system would plan for the high revenues coming from the premium traveler, not always the same as the business traveler, but many times the same. Those revenues would come, and you, as an airline, you would design your system based on these travelers. So that meant higher frequencies to a certain hub that would then send the business passenger onwards so they could reach their destination at the time they wanted. Now, we think now that the system will tilt its center of gravity. Instead of being a balance, it will tilt more towards the leisure traveler, meaning that the frequency of flights to a certain destination is not as important as before. It'll more be, hey, can I head to a certain place that's reasonably attractive at a certain price? And then we'll adjust our time based on that. So it's not all going to change, but overall, the center of gravity will head towards that. Point-to-point flights with fewer frequencies. That means low-cost carriers will be in a good position to grow, whereas the traditional business models, the traditional airline business models are really under threat here. We also know from airlines we've spoken with that the planning horizons are still short and will remain short for a while. Staffing challenges. Overall, it seems like airlines, typical airlines have let go some 25 to 30% of their employees, and that's across the board. How many of those can you bring back? Phil mentioned the kind of their strict cost and cash regimes. And then finally, greater focus on cargo. Cargo used to be the least important part of an airline, or the part with the least status inside the airline. We see huge changes to this, where airlines are really reconsidering the role of cargo. And one interesting case in point here is if you look at the revenue per cubic meter that an airline can get from its travelers, the highest revenue per cubic meter you get from the premium passenger, the lowest you get from the economy passenger, and then in the middle you have cargo. So cargo is the second highest revenue per cubic meter. That will impact the way airlines think about cargo in the future. So what does that mean for airline MRO and the requirements they put on their suppliers? Well, if you look to the right here, the bullets, we are seeing slimmer airline organizations, and what I mean there is these across the board cuts means that airline purchasing organizations are smaller, their engineering organizations are smaller, and that means they have a greater dependency on suppliers in general. If you before could deal with 50 suppliers, now if you have 25% less employees, you will probably need to cut down on your number of suppliers. That means the average supplier would need to handle more or a greater part of the airline requirements. At the same time, airlines also need greater flexibility from their suppliers because they don't really know what the future holds. The greater focus on cost and cash impacts what Phil mentioned, green time management. And on the green time management side, we thought in the beginning of the crisis here that obviously engines are impacted by this, or engine overhauls. We also thought that perhaps APUs and landing gear and nacelles and some of these heavy components also would be impacted by green time management. But what we've heard is that that has not been the case a lot, and the reason is that the airline organizations they simply don't have the bandwidth to be dealing with that. So that activity hasn't been impacted as much. What we have seen is inventory burn, airlines still burning out their inventory, but ultimately as they come back on the recovery path, they will need to rebuild some of these inventories, or at least require their suppliers to rebuild such inventories. I'll get to alternative materials and repairs in a while here. Here we really see, on the repair side, smaller work scopes, as Phil also mentioned, but also the rise of used and serviceable material. And we have some more slides on this later on. And then finally, modification activity will go up, including passenger to freighter conversions, potentially along the line here. If there is some cabin densification work, that'll really depend on how airlines see premium traffic recovering. But also, again, referencing Phil's slides before, looking at the number of end of leases that will be increasing in the coming few years here. That means transactions of airplanes, these airplanes getting into new fleets, and that means you'll need to do some fleet standardization programs and so on as well. Next page. So a little bit more detail here on the passenger to freighter conversion market. So as I mentioned, we see really a structural shift here from sea to air, meaning that there is really a tailwind for air cargo. And what you see here is the capacity, conversion capacity that we estimate over the coming few years. And this is based on the news articles about new conversion lines opening in different countries and with different players. And we roughly think it'll reach some 170 aircraft per year in terms of capacity towards the mid-decade. And we basically, to your question there earlier, Chris, is there really a need for this? Well, we actually think that demand supports this as it looks right now. The winners and the winning aircraft platforms, of course, that depends on how well are they, how well do they fit the mission, i.e., do they have a lot of volume, for example, to take on the less density e-commerce freight, and is there a feedstock of aircraft that you're able to convert? You see the winners in the upper right there. Next page. I think when we have spoken to suppliers over the past year, we have heard multiple stories of how important the cargo carriers have become to the supply side, to the MRO suppliers. And I won't dwell very deeply into this one, but if we look at the US airline MRO expenditures during the four quarters before COVID and then the 4 quarters during COVID, we really saw that cargo carriers, their portion of MRO activity really grew. So before COVID, they were some 20%. Now they're some 35% of the MRO demand. So that's been an important and growing customer to MRO suppliers. Next page. I mentioned USM before and how important this becomes to airlines, and that's obviously because they will need to keep their costs down. So will there be a supply of USM? Well, what you see in the chart here is the aircraft retirement trends over the past 20 years. And you saw it peak a few years after the financial crisis, 700 aircraft retired in 2012. And then the number of aircraft retirements actually went down, meaning there was fewer aircraft to dismantle and get used parts from. So we've actually had too little used parts in the market. Obviously, COVID changed all this. You see our, to the right, you see our pre-COVID retirements forecast. We knew there was a wave of aircraft that were going to retire pre-COVID, simply based on all the deliveries that came in the end of the 90s. But COVID just changed all this. And right now, I think 24% of the air transport aircraft are still being parked. And we think roughly over the coming 5 years here, some 6,000 aircraft will retire. This means not all of these retirements are going to turn into dismantled aircraft and used parts. We think roughly there will be some, say, 700 to 800 aircraft part outs. So the surplus parts market then will grow from some 2.2 billion in 2020 up to 4.3 billion in the coming few years here. And the platforms that represent the bulk of this are the A320 classics, the 737NG, the 777, and the A330. And that's obviously the center of many of the OEMs' aftermarket revenue streams. So they will be very impacted by this. Next page. The final thing I want to mention here before we get into the last slide is that before COVID, roughly 40% of the aircraft fleet was covered by integrated component support contracts in one way or another, either very broad component support contracts covering the whole aircraft, or some narrower forms supported by some of these component OEMs, 40% of the fleet. Now, the need from airlines in this, due to Corona, the airline needs have shifted a little bit. They still want the suppliers to cover their operative risk, and they actually have bigger needs than before for this, as I've mentioned, because they have smaller engineering and purchasing organizations. There is still, this EU directive that if you're late more than X hours, you will need to pay a certain fee to the passengers and so on, which is a huge threat to airlines, especially in a cost competitive environment. So they still need to perform on time, which means dispatch reliability is still important. But the airlines also need much more flexibility from suppliers. So we've heard about pandemic specific regulations in some new contracts. The rule for minimum flying hours is sometimes removed. Do we sign up airlines for 10 years, or is it a more flexible contract period? What about payment terms? What about the scope of these contracts? We've heard that airlines perhaps are not interested anymore to sign the really, really broad contracts, but that they focus more on the items that are really moving. and then they take whatever else ad hoc. So they have this need for greater flexibility and greater support from the suppliers. And that's all well, but from the supply side, if you view this from their end, it means that they need to provide things even cheaper than before. And this integrated contract space was very competitive pre-COVID. It becomes very important for these players to continue leveraging kind of USM acquisition and management capabilities. They need to, when they sign a new long-term agreement with an airline, they need to understand what are the odds that this airline will survive during these coming 5 or 10 years. What are the odds that we will get the cash flows to cover the investments we're making into this? And we've heard that new contracts need to carry more financial securities due to the risk involved here. So from the supply side, it becomes more difficult to make the business case for a really, forward-looking investment into these types of contracts. And the result is actually that a number of players have pulled out of this market. There are fewer integrated providers now than there were before. And if you want to be able to construct these broad agreements in the future, you will probably be more, or these players are more dependent on creating partnerships and turning things into virtual pools with multiple players so that you better can utilize the assets that are in the system and avoid spending too much cash. And then final page. So if you look at this from the supplier point of view, the OEM side, the aircraft OEMs have they have very lofty goals before COVID. They have kind of revised these, both Airbus and Boeing, focusing less on these broad support contracts. However, it seems like Airbus has continued to sign a number of these agreements. We think in a way this is also to support their aircraft sales with some of these airlines. From the component OEM side, as I mentioned, a large portion of their aftermarket here is on platforms that are very susceptible to USM. So they need to position their offerings to a much more price sensitive audience. And that means greater focus on USM and potentially other types of partnerships. The engine OEMs, their focus now is on managing the expected real ramp up in engine MRO activity. All this green time that is happening at the moment, that will at some point, those engines will need to be maintained. And so that recovery on the engine side needs to be managed and they need to be able to ramp up not only their own activity, but their supply chain. Amongst MROs, as we mentioned, there are fewer companies providing integrated support today, and they kind of need to adjust their offering to become more flexible. The small independents, which for a long time we saw as pre-COVID, they were having a more and more difficult position in the market as OEMs had expanded their territory. We now see that these smaller independents are actually quite well positioned because they have a lower cost base and typically cover the platforms that have a large amount of USM in them as well. However, the supply side here, they also have these human capital constraints and will have troubles ramping up. We also obviously look at what will happen with the major integrators, and you may have read in the news of Lufthansa considering selling portions of Lufthansa Technik and so on. What does that mean for the relative, how they view where they need to put their capital in the future? We talked about the USM suppliers and then also passenger to freighter conversions. So the passenger to freighter conversion suppliers, they are obviously the same providers as do the MRO. They have mentioned that they have established a lot of new capability for passenger to freighter conversions. We're seeing a big ramp up in this, but question is too much capacity being added? Will there be an oversupply mid-decade here? We will see what happens there. So with that, I think I'm through my material here as well. I'm happy to take any questions.
Thank you, Jonas, for your presentation. Really great insights into the MRO and the supply chain. Just a question for you with respect to cabin reconfiguration, modification. Before COVID, we saw a lot of activity on that respect as airlines were trying to bring new technologies into the cabin and so forth, transforming their business class with the new market development. And also an additional factor, the new record sales of corporate and business jets, like Gulfstream, Bombardier, and Dassault in Europe. So what do you see an impact on the business class for airlines that makes it's kind of the bread and butter for their profitability? What are your views on that? And do you see MRO work happening in that modification space?
Yeah, really profound questions there, Chris. And yeah, there has been a certain portion of the market that headed into, as you say, business aviation, and apparently the offerings in business aviation have become more as well. So I mean, before you would have a corporation or an individual purchasing a business aircraft, and they still do, but you have actually also a greater use of these asset sharing programs, where you basically just get access to a business to a few flight hours of an airplane, and that is for sure a threat to a certain portion of the business traveler, although I think it's still in the margin. The overall threat, I think, still remains how much business travel will actually happen during the coming 5 years. That I think is the big. So the next question there is, well, what does that mean in terms of MRO? How do airlines treat these cabins? If, let's say, business travel or premium travel remains low over the coming few years, should you spend money on remaking your cabin into a complete leisure cabin? Well, that's an investment, and you can't be sure that you make the money back, because that means you've got to attract all these extra economy passengers for the same flight instead. So I think airlines are waiting a bit to do these cabin densification programs at the moment. We'll probably need to wait another year or two before we see that. What we did here in some of the research we did was that a way for airlines to save cost without impacting service too much is actually to remove the IFE from the cabin. The IFE is a real cost driver, the touch sensitive IFE, and instead you can install Wi-Fi. So people use their own tablets and so on instead. So that may be a change that we see.
Thank you very much. And one last question before we go to the next presenter is, how will the reconfiguration of supply chain that you mentioned earlier from, becoming air cargo conflict with environmental constraints and policies? I mean, on one thing, we say that we are getting into environment and sustainability. On the other hand, we're promoting e-commerce that it's really booming because of air cargo. So there's a shift from the slow moving, less, let's say, environmentally unfriendly cargo moving to air cargo that consumes more fuel. What are your thoughts on this?
Yeah, that is a really good and also fundamental question. And I think air cargo will clearly be under pressure to kind of also answer to those types of questions as the rest of the airline system needs to do. On the other hand, if you compare with ship, the ship freight hasn't been known for their environmental friendliness either. So in a way, I can't really speak to the net effect of this when it comes to the environmental factor. But from an aviation point of view, these players simply need to just be part of the response here.
Okay, thank you very much, Jonas. Thanks again for your participation and your input into this. It was greatly appreciated. And if you have more questions, please, Jonas's email is up there, or send us the questions and we'll forward them to him. Thanks again. So with this, we'll go over to the last presenter for the day, which is Swaran Sidhu, Head of Fleet Technical Management at easyJet. So Swaran, it's all yours.
Thank you, thank you, Chris, and good afternoon from the UK. You know, there's always pressure on the last speaker, especially with Phil and Jonas setting the bar for me to match, and also keeping the audience engaged. Hopefully, everybody are still there listening to these, you know, very good conference in my view. I'm going to talk about in my presentation about the airline's journey through the pandemic. And though I'm still very cautious about, you know, when this full recovery will come. I'll also talk about what happened during the pandemic with our operations, the cost strategies that we put into place, and also now operating into the new normal. So if you could go to the next slide, please. This is just a kind of a reminder for everyone in terms of the pandemic. You know, it's always easy to forget because you know, the airlines is such a kind of a fast environment, at least certainly in the pre-COVID levels, you know, up to 2019. So, you know, one day is certainly always too short in my view, but it's good to remind ourselves what everyone went through during the pandemic. I think if you look at what I've put up there in terms of the timelines, I'm sure many of you from the airline world, or even to a degree the MRO world, could you know, relate to this. If you look into during March 20, the pandemic was declared by WHO. You know, the world's fleet got grounded, and that included commercial and obviously freighters too. And you know, and airlines spent a lot of time trying to make sense of parking and storing aircraft, and that wasn't easy. And you know, airlines are used to kind of you know, keeping aircraft flying, maintaining them in that condition, having passengers on board, but this was a different world altogether for them. And followed with that was a lot of bombardment, certainly comms that were coming from the industry like EASA, you know, the ECDC, you know, IATA, everybody else who were trying to help to, you know, airlines coming to terms with this, and you know, trying to understand all the different directives that were coming from, you know, your own local regulatory authorities, including the, you know, the wide authorities around the world. The type certificate holders, the OEMs, you know, they were taking the lead to help the operators and trying to get them back to where they needed to be, and knowing that the, you know, at that point it was very hard to kind of know where, you know, where the pandemic was going to go, how long it was going to take. I mean, I recall someone, you know, somebody saying during the time, well, this is only going to last for 3 months, and yeah, here we are almost 2 years later. And there were a lot of retrenchments and furloughs that followed. You know, there was a lot of pain in that too, where many, you know, many good people, skills lost their jobs. And some of them, as I think Jonas mentioned as well, and then so they feel they're going to be hard to, you know, will they ever come back to the industry? I mean, again, then moving on to the period between June to November 2020, you know, there was some resumption of flying. And although, you know, we were certainly in easyJet around about 40 to 50% of what we flew pre-pandemic. And combined with that, there were many strict biosecurity measures that we had to adopt, both on the ground and in the air. This was making sure that the passengers were comfortable and feeling safe to travel with us. And of course, even your own staff were quite concerned, and you had to manage that too within your own organization. There was confusion on the biosecurity regulations in terms of the PCR test that was out there, and the different governments make kind of interpreting the rules differently. So there was a lot of difficulty for passengers trying to get through this myriad of regulations and then making that final decision to book a flight. And there was a deep internal cost reviews that were carried out within the airline, and I'm sure many airlines did the same. And and this was done in various aspects that I'll talk a little bit more in the later slides. And we renegotiated our aircraft purchase agreement with Airbus as well, because we had a whole host of delivery spending for the remainder of the year. And then from November 20 to March 21, international travel was kind of almost limited to repatriation flying, and business travel outlook was gloomy. Amazingly, we started to enter into the second lockdown, which wasn't expected at the time, but you could almost follow the pattern around the world, and you could have guessed it was going to happen to you. I mean, Australia led the path, and in fact, if you go follow what happened in Australia, that's exactly what happened in Europe as well. And in terms of how we looked at our cost into preserving cash, I mean, we were renegotiating supply contracts. We were looking at every aspect of our operation, how we can do that. There was a lot of end of lease activity going on, and in fact, this almost came as a knee-jerk reaction to say, that was the most focused place in terms of how we could get rid of aircraft very quickly, in terms of leases that were coming up for renewal, and in fact those that were pretty close as well to hand them a bit earlier. And all this is down to cash preservation. From March to June, the lockdown kind of got lifted in March, and flying resumed again. But when you look within Europe itself, I mean, the UK Brexit at that time, and it became a third country. So whilst intra-European travel kind of resumed fairly well, the travel from the inter country travel was difficult. So certainly our AOCs in Switzerland and Austria were doing pretty well. They were pretty much back to full flying. We were still about 60% of the pre-pandemic levels. The PCR test was still a problem in terms of cost, and again there was confusion of what was accepted in terms of testing and what wasn't. Passengers were coming there with certificates that were PCR tests done at government test centers, but there were specific test centers that were allocated by the government on their websites, and people were missing their flights, and then it kind of put people off booking future flights as well. And then from June 2021 to now, where we are today, as I mentioned earlier, our European and which is the Austrian and Swiss AOCs are now back to full flying. We are around about, although I've got 65% there, we are around about 80% now within the UK domestic flying. And again, a lot of restrictions from the government, although since I put this presentation together, only on the 4th of October, the UK government made the restrictions less restrictive. And I guess, we still are trying to figure out, are we out of the woods, or I would say the variants yet, are more variants to come that will impact our business. Next slide, please. And this is our airline operation. So kind of giving you an idea where we are with the network itself. I mean, that's our route network map there. And if you look at the yellow line and the green and the blue lines, that shows you the different AOCs we have and the aircraft types on the right. And you'll see that the Swiss AOCs and the Austrian AOCs are pretty much 100% flying, and you can see we are around about the 80% mark. And in terms of the aircraft types, on the A321s, we've got 14 aircraft at the moment, and the A320neo we have 37, and the A320ceo aircraft we have 167. That's the largest portion of the fleet, and the A319, the 106 of those. And that total to 324 aircraft, and that pre-pandemic level numbers were 342. So we had about 20 aircraft reduction in that. And out of the 20 that were kind of taken out of the operation permanently, some are still kind of stored and others returned back. We've, mostly the 319s exited the operation, trying to get a more fuel efficient aircraft, operating for the operation into the future. So can we go to the next slide, please? I mean, if you look at our maintenance activity, again, I know Phil mentioned about, airlines cutting back on the maintenance activities, and that's quite natural to do that. We parked all our older MSNs, we rested them to avoid expensive heavy maintenance cost. And the top slide that what you're looking at is the line maintenance activity that is pretty much matching how the pandemic kind of panned out, from the start to where we are now. So you can see that the line maintenance activity is almost panting up to the pre-COVID levels in 2019. And if you look at the green one, that is our kind of light base maintenance activity, which is our equalized program. So we have 5 network stations that perform that work overnight in an 8-hour layover period. And that has been kind of pretty much stable, although there were some dips during the periods of low flying. And we also had the heavy base maintenance activity. It was fairly stable in the early part of the pandemic because we were already committed to some of the winter programs, and then we elected to do some of the modification that we had put off for quite some time, that there was no downtime available, pre-pandemic. But there was some activity decrease as well, as you can see towards the later part of the pandemic as well. Now, in terms of the MPD or the AMP requirements from the regulatory perspective, we looked at it carefully within the lower and the upper thresholds of flying in terms of the flight hours to cycles ratio. We were clearly below our lower threshold, but we engaged very quickly with our regulators and ensured that we were doing all the required tasks, specifically anything that was mandatory, and then we had to change our AMP prephase to highlight that. So next slide, please. So these are some of our cash preservation strategies that I think I've mentioned some of those in my previous presentations. Now, particularly on the engine side, like many airlines, and I know some of it was mentioned by Phil as well in his talk earlier, we had to optimize our shop visit plan, defer engine shop visits to preserve the cash flow. And we also looked at the work scope in terms of optimizing the end of lease shop visits. We wanted to make sure that the return conditions were, looked at, and the engines were maintained at the lowest shop visit cost possible, so that we didn't end up spending a lot of money for the end of lease exit activity. I mean, normally we have hardly ever use second-hand LLPs. We tend to buy them new, and we used to forward buy LLPs to try and beat the market rates in terms of escalation costs. But we found ourselves, dwelling into second-hand market for LLPs to reduce our end of lease shop visit costs. And we were also parking in storing engines that were leased. So if we had a lease engine installed on an airframe, we removed those, rested them. And we, in fact, even started robbing parts from engines of some of the aircraft that were parked to keep the small operation that was flying, to avoid leasing any engine in, either through bird damage or any other problem that you experience with engines. And then, of course, there was the human resource element as well. You know, there were furlough schemes, there were redundancies, and we've ended up as a smaller organization. Although it's not largely small, but nevertheless, there are less people there now than there were before. Our end of lease activity that really ramped up, and we had to utilize the same number of people, utilize the strength within the organization where people had these skill sets, and formed a team to kind of deliver that. And we had to look at all our MRO costs, renegotiated contracts where we had to, and looked at our heavy maintenance visits, and where we could delay those visits, we did. And where we had an opportunity to actually do some of the stuff that we were not able to do previously, we then did that too. In terms of the supply chain contracts, we were in the middle of an RFP anyway, and we ended up renegotiating that contract, and we ended up into a position where we were not going to be caught into the difficulty, you know, of a supplier being caught out on the flight hour rates when an aircraft is not flying. Equally, the minimum number of hours that you should be flying, where it's listed in the contract, and you have to end up paying for that too. So all that had to be looked at and renegotiated. In terms of parking and location, we had to look at consolidating the aircraft into one place, or at least some places where there was our own network MROs, and the fees were a lot lower as far as parking was concerned. And we ended up doing that eventually. So we had aircraft parked in around about 5 different locations where we had all the MRO support available. And we also ended up with a new supplier for our records management services. This was linked to the end of lease activity. We needed a system that was far more superior and capable of giving us that leverage over the number of people that we had, and it gave us more kind of automation capability. And that was part of the innovation that we had to look at and say, you know, look, we can't increase our people, but how do we manage this huge end of lease activity? And that was one of the things that we did. So we transitioned onto a new supplier that was capable of giving us that service. We also looked at our MPD, and we looked at our C-check in terms of optimizing that as well, and end of lease clearance by looking at individual task reviews rather than a package of C-checks. So that was done in a clever way, and making sure that you had minimum activity to clear the aircraft for the end of lease purpose. And of course, there was process review carried out in every workflow that we were doing, putting automation where we could, and increasing automation, doing things that we were doing previously even better. Your next slide, please. So that is our technical operations and how we've performed since the pandemic. I mean, if you look at the 2 slides, the first slides that you're seeing on the left is the availability of the aircraft, and the slide on the right is the technical dispatch reliability. And the darker line was 2020, and the orange line is the 2021 period. You can see that we had a bigger dip in the 2020 period, and we were far better coming out now in 2021. And the reasons for that is, I think we learned a lot more from the parking period, and a lot of things were put into place. And I know on the previous MCTG seminar, Keith Fernandez from Virgin spoke about how they managed to put things into place to get the aircraft technical performance better. So these are some of the learnings that we adopted from the Airbus newsletters, from experience with other operators. And you can see our technical dispatch reliability certainly became much better during the 2021 period. And the aircraft availability was certainly improving a lot more than it was in 2020, sorry. So if you go into the next slide for me. So what is the new normal? And obviously things are never going to be the same, and many things have changed. And these are some of the things that I'll just kind of highlight and show what we are doing as an airline. Hybrid working has now become the new normal. People have to now book their desk space, and then there's a QR code on your table. There is no specific desk space that you could say is yours. You can work anywhere within the organization and come into work. However, it's hybrid from a point that you don't have to be in office all the time. You can kind of share that between your time from home or elsewhere, and then come into work as well. Now, having said all that, we've not kind of put a lot of restriction in terms of booking your office space for the engineering staff. We have a specific floor allocated for ourselves, and again, we are hybrid working. We do allow our staff to work from home, but there are people who have to be there 5 days, 5 or even 7 days for the matter, 24/7 coverage where the frontline operation is concerned. So, for example, when it comes to MOC, it's a shift system like many other airlines. People have to be there all the time, and so it is a different way of working. People are getting used to it. There are advantages, there are disadvantages, but we are working our way through it, and it is working for us. We spent a lot of time on training and development during the pandemic, and when I said development and training, it's not something that we paid for. It's an internal online learning academy, our own people setting up training for people, including both for people who are on furlough coming back into the organization, getting them trained up. It also was training in terms of what we did in our operation, whether it was engineering or maintenance related, whether it was commercial, whether it's finance. So it was pretty much throughout the whole organization. What we also did was we looked deeply into our insourcing and outsourcing decisions, and we started to really hone in on what was important to us, what was worth insourcing, and we did insource a couple of contracts in terms of line maintenance and some heavy maintenance stations as well. So particularly Berlin, we've insourced our line maintenance there, and we are in the process of building a hangar that was previously an outsourced station. We also looked at technology and how can we use it better, and whether you're working from home, transitioning from Skypes to Teams and Zoom in some cases, Google Meet as well. So you're getting used to all this new technology, better IT support. All this was slowly but surely falling into place. We upgraded our planning tool, AeroAgility, and making sure it was giving us more features and capabilities. And we spent a bit more time improving our maintenance information system, AMOS, and getting people to understand more of the modules that were within that. And so we were basically ensuring that the technology that we had in place was going to be stretched further, leveraged to give us all that advantages that we need without having to take in additional resource. We concentrated on organizational restructuring because of the number of people who were either furloughed or retrenched or redundant, and there were more kind of responsibilities taken up. Whilst the organization has always been quite lean in terms of structures, but there was a lot more streamlining done to reflect the job to the workflow that kind of existed within that part of the organization. We also started to learn how to live with the new world of parking, and I think whilst we said we are coming back to full flying, again, we are faced with a winter here that is going to end up with aircraft that are going to be parked. Now, when you compare that to previous winters in 2018, say 2019, the aircraft were parked at a maximum of 5 to 7 days at a time, and they were back into flying. Here now we look into a new world of aircraft being parked for a lot longer periods in the winter periods of when flying is a lot less. Biosecurity measures have changed, both in your workplace and both on the aircraft. people around the MRO environment. So everybody are a lot more conscious of what could be there. We are still encouraging people to wear masks, sanitize your hands, and not come into work if you're feeling unwell, and something that you wouldn't kind of do in a pre-pandemic. And but now we are very, very much into biosecurity, and the cleaning regime of the aircraft has certainly increased extensively as well. And then we also looked at working on upgrading the equipment our people had. So there was a lot of changes to our systems, and laptops were upgraded. I know it sounds strange to tell you that we are now on Windows 10. I'm sure many companies had already transitioned to that, but this is one thing we did lack was our IT upgrades, and that was done. And we've moved into Skywise Core and looking at Skywise health monitoring in terms of predictive maintenance. So we've got a lot more integrated kind of reliability department that's now moving more towards predictive maintenance and helping the Skywise, the Airbus side of Skywise, and working with them closely to deliver our aircraft performance. And then we also did revisit our maintenance philosophy as to the current way of how we do our maintenance. As you know, we do equalized maintenance on our aircraft that are up to 6 years old. Beyond that, we've converted them to block maintenance. I think 3 years ago, in fact 4 years ago, we were not converting them to block before 12, but about 3 to 4 years ago, we changed that philosophy to 6 years. And we revisited that again during the pandemic, but after a lot of analysis, we decided to leave it as it is at the moment, where we will be still maintaining aircraft on an equalized program up to 6 years, and beyond that, they are on block. And then finally, we focused a lot more on sustainability, and whether you're looking at aircraft into the future, and we partnered with Airbus, like many other airlines have partnered with different organizations towards electric or hydrogen aircraft. We are also looking at different fuels, and of course looking within your own office environment. There's a lot more to do as well, for example, being paperless, etc., and getting more automation in. So all those things help you as well in terms of your carbon footprint. And in fact, to a degree, hybrid working kind of contributes towards that as well. So can we go to the next slide, please? So is there a sign of recovery? We think there are, although it's still very cautious. I mean, when you look at the news, for example, in Miami Airport, they have detector dogs, for detecting COVID. I mean, that's innovation for you. And Emirates, really moving towards digital innovation for their passengers, and Eurocontrol, moving towards data that reveals, how the aviation community is recovering from the COVID. And if you look at the IATA figures, that they're slowly increasing, but still, although they remain below the pandemic levels, but the trajectory is towards the right side. And the airports around the world, trying to get accreditation of health, and then Eurocontrol data showing delays that were caused by the COVIDs. But again, these are some of the signs that are pluses, they are negatives. Is that a sign of recovery? I mean, we think so, and but again, something to watch the space. It depends on the variants that are going to be there and how the vaccination acceleration takes place, as Jonas previously in his slide pointed out to you. So can we go to the next slide? So finally, just to summarize, we have to kind of embrace and embed the new normal. And if you can classify that as the new normal, whatever that is, and I mentioned what our new normal is, viewing the crisis as an opportunity, and taking advantage of the period of downtime, and what are the things you can do without bleeding cash out of the organization, getting your people trained up, getting them better, doing the job even better than they are currently doing. And then obviously showing good leadership is really important when you take your people through this journey, especially during a crisis. People have to look up to you, and that there are times of difficulties for people, both mentally and both physically, and trying to make sense of what's going on and what the future is going to hold for people. And this is where leadership has to come in to take the people on that journey, and then learn the lessons that you've taken out of this pandemic, and certainly document them so that your future leaders are there to be able to guide the organization out of a crisis like this into the future, and make sure that you keep it safe. And I mean, I don't know when the next pandemic may turn up, but if it does, you'll be able to deal with that, and make sure you tell your grandchildren this story. I'm sure they will want to know that what happened and how did you navigate your way out of this one. As far as easyJet is concerned, we are currently, if you look at the graph, on the recovery phase. And as you can see, we did started from the grounded phase like many other airlines. We had to go into a mode of survival, where we have to preserve cash, looked at restructuring, looking at our people, our equipment, our network, and then moving into the recovery phase that we are now. But clearly we have to move into a sustainable growth phase so that we can get the airline back where it was at the pre-pandemic levels. And I think with that, my presentation ends. I thank you all for listening, and I'm open to any questions that you may have for me.
Thank you very much, Swaran. I think it was a great presentation. As always, you treat us well, so thanks for that. And there are some questions with respect to the model that you said about hybrid work, and has that created an opportunity for you to further outsource even some of the office activities? How would you see this issue with hybrid work? Did you reduce the headquarters footprint and so forth?
Yeah, thank you for the question, Chris. Yes, certainly we did look at all our facilities. I mean, we had 3 to 4 different facilities where staff were kind of posted. So we have reduced it significantly down to only 2 facilities, and the hybrid working clearly helped to do that. Moving into the future, we think we will remain in that manner. But I always add caution to this, because it's human nature. Memories tend to be short, and there's as the airline grows again, I'm sure there'll be pressure on people wanting to increase that. But I think for now, into the midterm, between now and then, I think hybrid working is there to stay for sure.
Okay, thank you for the question. Are you still? You mentioned about the change of strategy. It was before the equalized checks were 12 years. Now you push them down to 6 years, and then you after 6 years you turn them into a block check. Are you still looking at this continuously, or this is to stay for quite some time?
This is a continuous review, Chris, and what we do is on an annual basis we revisit our philosophy, looking at the airline's operation to make sure that it's still fit for purpose. And currently I would say at least certainly up to the medium term, it's going to be fit for purpose, because 0 to 6 years aircraft are fairly young. The maintenance requirements on them are not so deep as far as the cabin is concerned, or modifications are concerned, or in fact, operational defects, that unscheduled events that may happen. So those things are easily containable on equalized maintenance. But I think once you go past 6 and beyond, we start to see the cabin becoming tired, and you need more ground time to work that. So the equalized program becomes a bit challenging. And then, I mean, the cost between the 2 programs is very, very marginal. There's no advantage or disadvantage in either. But what the equalized program does, it gives you more available time for the airline to fly the aircraft.
Okay, thank you, Swaran. I think we'll stop here. Actually, there is one more question just came up. How easyJet is using Skywise to predict aircraft performance?
Yeah, I mean, when we say aircraft performance, I'm assuming it's a technical performance we are referring to. And yes, absolutely. I mean, we were the first people who worked with Airbus and actually led them down the path, pioneered the way into predictive maintenance. So we utilize the modeling of the the system within Skywise, where all the data is entered from your maintenance data from AMOS in our case, that is fed into Skywise platform, and from there, we've worked with them on the models that are capable of being alerted. So for example, I could give an example of a a bleed system where a OPV valve is opening or closing slowly, and we do get an alert to say that the behavior of that valve is not the same as its normal operation, and then you have to do a small amount of research on it to see previous defects on that, and eventually you go into a point of a scheduled removal of the component that helps you avoid a costly AOG delay. Now there is a lot more work going on in that area in what they call Skywise Core, where you can go into there and start researching your history of the aircraft very quickly. It gives you the speed and efficiency to track component history, and you can go all the way up to your shop reports and repeat defects and marry up the information to make an informed decision. Now we are moving into SHM, which is what we call Skywise Health Monitoring. It allows you to actually individually look at ATA chapters and say, how's your chapter doing? What's the health of that in terms of what you would do in your normal reliability analysis. It's a very powerful tool, and it's certainly helped us into getting the fleet performance improved.
Okay, thank you very much, Swaran. I think that was the last question. We appreciate, as always, your insight into these presentations. And
Thank you.
with this, we kind of conclude the fourth and last episode of the MCC series. We have the links here on the screen for you. If you would like to join our maintenance cost technical group, please, you are more than welcome to send us an email and make us aware that you would like to join. We have the technical operations working group also set up, and you can see the sites there, and also a lot of material about safely restarting the aviation industry on the IATA website. And with this, we conclude the MCC 2021. If you need any more information, please get in touch with Geraldine or myself. Our emails are there. Visit the website to view the presentations and the webinars that they will be, even this last one will be posted there in a couple of days. And we hope to see you next year for MCC 2022. We're working to have it on a face-to-face meeting with excellent presenters as of today, and in all these 4 webinars that you've seen the last month. And enjoy the rest of your day wherever you are. Thanks again for all your attendance. Goodbye.